Crude oil fell this morning on OPEC's plans to start returning barrels to the market after the third quarter of this year. Indian stocks rallied to a record and rupee gained at the wake of the Indian elections. And elsewhere, optimism is back to the market after Friday's satisfactory inflation print from the US, and as the Bank of Canada and the European Central Bank are both preparing to announce their first rate cut this week. So, welcome to the new week of trading with Swissquote's Daily Market Talk. So first things first, OPEC Plus announced on Sunday that it will extend its supply cuts to the third quarter of this year, but then it will gradually return barrels to the market over the following 12 months. So the idea that OPEC has now a clear timeline for slowing its supply cuts is obviously not supportive of oil bulls. So the barrel of US crude started the week by falling to $76.50 level at the weekly open before, however, rebounding toward the $77 per barrel level on the back of a stronger than expected Chinese manufacturing PMI, with the Caixin index pointing at the strongest expansion in manufacturing in nearly 2 years. Now also note that the interest rate cuts from major central bank could help temper a soft OPEC decision on Sunday on its supply strategy, but could not be enough to send oil prices to a sustained bullish journey unless global growth expectations improve on a softer monetary policy outlook from the major central banks on the face of this globe. And the economic picture is getting quite complex, mind you, because the economic data, the central bankers' comments here and there, and the expectations from the market are all over the place right now. And every piece of new information that flows in will suggest just another policy outcome for the rest of the year. And everyone, every trader and every analyst out there is quite confused right now. So if we put things back in order and in perspective to understand how and why things move in the market toward the direction that they move, well, a part of last week was, remember, marked by weak sales of US Treasuries amid the Federal Reserve minutes showed the week before that many Fed members were actually wondering at their latest monetary policy meeting whether hiking the interest rates in the US wouldn't be an idea to temper inflation. Then, well, that was bad news, obviously. So, happily for the Fed, a lower than expected US GDP and softer than expected consumer spending in the first quarter of this year, well, helped temper the rising hawkish Fed expectations on Thursday. And happily for the Fed and happily for everyone else in the world, well, the core PCE data from the US showed on Friday that inflation in the US met the expectation of 0.2% monthly advance in the month of April. So that was the smallest advance of the year, and personal spending in the US also grew less than expected by analysts as well. So the combination of softer than expected growth figures and spending from the US, combined with the satisfactory inflation read from the US, gave some relief to the market on Friday's session. As a result, well, the week ended on a more dovish note compared to when it started. So the US 2-year yield slipped below the 4.90% level after having tested the 5% psychological mark earlier in the week. The 10-year yield is below the 4.5% level. The S&P 500 recovered 0.80% on Friday and closed the week just 0.5% lower, as Nasdaq managed to close a difficult session near flat and limited losses to around 1.1% for the week. In the individual space, Salesforce rebounded 7% on Friday after a 20% sell-off following its disappointing quarterly results, because remember, they announced weaker than expected first quarter earnings. Dell They'll drop nearly 20% on Friday despite a first quarter revenue beat. Nvidia and AMD didn't react much to the news that the US is now slowing the issuing of licenses to its chip makers for large-scale AI accelerator shipments to the Middle East, as it apparently conducts a security review right now. But the news obviously showed how the geopolitically tense global setup could eventually prevent these AI-related companies from exploring their full potential as AI continues to spread over companies, over sectors, and around the world. So hopefully, I say hopefully, the surviving chance of a Federal Reserve rate cut or two could finally help improve the investor sentiment this week, as eyes are also turning toward the Bank of Canada and the European Central Bank that are preparing to announce their first rate cut as early as this very week. Now note that the European Central Bank has been quite clear, and probably a bit too clear, on its intention to start cutting the interest rates in the June meeting. So they can't really back down now. So there will probably be that 25 base point cut announced this Thursday in the Eurozone. But the truth is, Friday's CPI update for the Eurozone economy wasn't much enchanting for the European Central Bank does. Because in fact, consumer prices in Europe accelerated from 2.4 to 2.6% in May, as higher than 2.5% expected and penciled in by analysts. And core inflation in the Eurozone unexpectedly spiked from 2.7 to 2.9%. So the latest CPI update, didn't bring much confusion regarding the European Central Bank rate cutting expectations this week, but somehow killed that hope regarding a possible and a second rate cut in July. As such, and in the light of the latest developments that we see on the economic data front, the ECB's communication on what it's planning to do next amid signs of quickening inflation will matter more than the cut itself, which already priced in. So if the ECB sounds cautious regarding the rising upside risk to the price stability in the euro area, and that's my base case scenario, we could very well see the euro get some support following a, choppy end of May. The euro dollar is trading near the 108.50 level this morning at the time I'm talking here, but in all cases, the euro dollar will need more than just a cautious ECB stance to clear a solid 1.10 resistance. It needs soft US data indeed to, weaken the US dollar to advance in this upside journey. In this respect, we will also be watching the US reveal its monthly jobs numbers throughout this week, which are going to be very, very closely watched by international traders, and hopefully they will be soft enough to keep the Federal Reserve hawks in a cage, but strong enough to maintain the hope of a soft landing for the US economy following a cycle of pretty aggressive policy tightening in the US. So there you go, now I sound like a real Swiss. Elsewhere, in the meme and politics space, yes, I put them in the same basket right here. Trump's media and technology group actually slipped 5% on Friday's trading session as the ex-president and candidates to the White House in the November elections in the US was found guilty on allegations for falsifying records in a hush money trial in New York. And in other news, GameStop will be revealing its earnings after its stock price rallied on a Twitter post from Roaring Kitty, remember, just last month. So let's see if there was anything interesting and worth looking at in their quarterly report to support the rally that we saw a couple of weeks ago, which I personally doubt. In India, the Nifty 50 jumped to a fresh record and the Indian rupee rallied as exit polls to the Indian elections this weekend hinted at a clear-cut victory for the present PM Modi's party. And in separate news, the S&P upgraded its outlook for India from stable to positive and threw the foundation for a higher credit rating for the rising EM giant, which will obviously allow them to lower their borrowing costs and give a further support to their economic rise. So all in all, India is now looking promising for investors who, however, are brave enough to take a dip in this market. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.